It does take us to our talk of the tape. All that is on the line at 8:30 a.m. tomorrow morning, the release of the Consumer Price Index. Let's ask Liz Young, SoFi's head of investment strategy. She is with me at Post 9. It's good to see you again.
Yep.
All right. Are this all the marbles here for this rally tomorrow morning?
Big day. Well, I mean, the rally has already sort of conked out, trying to figure out whether or not it should keep going. I think today, if you look under the surface of what's happening, first of all, we're on day 284 of no 2% correction in the S&P, which is the longest. I did one by one. I tallied them all up. It's the longest we've gone without a 2% correction since 2018. So I say that because we are used to the market going up. We are used to this for now a very extended period of time. So some of these pullbacks feel really alarming. But in reality, since the last high in the S&P, we're only down about 1.2%. This is not a big deal. So when you look at the rally pausing, I think what a lot of investors are still waiting for is that bigger correction. And the narrative continues to be that on a correction or a dip, it should be bought. We haven't really had a good, meaningful dip yet. Tomorrow could be the day that starts a good dip, but that doesn't mean that it has to end everything.
Anything but very hot on the CPI is good. Like we can, in line, obviously, I mean, JP Morgan says in line, the trend stays in place. Stocks grind higher, led by large caps. So largely the story that's been told, very cool. You could have an even bigger move. I don't think that would be a surprise to anybody. It's the very hot scenario that could lead to some weakness. And then you really get some nerves tested as to where we are.
Yeah, well, and just to prepare everybody, the expectations are for headline CPI to be higher this month than it was last month, so there will be some heating up. What the Fed has continued to say is that January and February coming in hotter than expectations is still in line with their expectations. If that's the narrative that we get from them, again, maybe not alarming, and there's been plenty of Fed speakers over the last 2 weeks to tell us what they're actually thinking. Of course, I think a way too hot CPI number is going to be a problem, right? That would send jitters through bond markets. It would send jitters through equity markets. It would send jitters through rate expectations, all of it. I think the real issue would be if, number one, there's two options. The first real issue would be if hikes come back on the table in a real way. Right now, we're still trying to decide whether or not we'll get a cut in June or if we'll get 2 or 3 this year.
Hikes seem like a real outlier.
But if you get a hot
outlier.
Not as much as I think they're less of an outlier now than they were in January. That's probably an agreeable thing.
Because of the recent hot reads that we had?
Yes, and because of growth staying as strong as it has, because earnings have stayed intact, because the labor market has stayed intact. So the economy has proven, against all odds, that it's been able to withstand these hikes. And if inflation continues to be a problem, and we're looking at 3.4% headline CPI tomorrow, I would still call that a problem for the consumer. Then the Fed does have to reintroduce the idea of getting harder on it again because we haven't quite defeated it yet.